All right, good evening, everybody. Thank you for coming out tonight to our new, beautiful venue here. This is, I think, the first time we're having a meeting here, and it's a terrific place. My name is Stefan Magnuson, and I'm your New York chapter co-director, along with Lon O'Sullivan here, who will be moderating tonight's discussion. Tonight's meeting is underwritten by the GARP chapter program and funded through member dues. I'd also like to thank tonight's sponsors for the special event. That includes Deutsche Bank, DTCC, EY, FINRA, SIBA International, and the Federal Reserve Bank of New York. We really appreciate the support of our sponsors. Without their help, we couldn't bring such great programming to our members here. If you're not already an individual member of GARP, I'd really encourage you to join. You will have full access to all the member benefits while supporting your local chapter and the global mission of your professional association. So first, a few notes before we start. Registration for the May 2015 FRM and ERP exams opens on December 1st, and you can sign up at garp.org. There was a significant milestone reached this year when more than 40,000 people registered for the FRM exams in this calendar year alone. Since the global financial crisis in 2008, registrations have increased 194%, and this reflects the greater industry need for certified risk managers and also the value that candidates recognize in their professional and career development. In addition, we have nearly 1,400 people registered to take the Energy Risk Professional examination. The ERP, it's a newer and smaller certification program, but it's growing very, very quickly. For candidates taking either the ERP or FRM exam on November 15th, of course, we all wish you the best of luck and hope it all goes well. If you are already an FRM or ERP participating in GARP's continuing education program, you'll receive 1 CPE credit for tonight's meeting, so please go ahead and update it in your credit tracker. If you'd like to tweet or post about this meeting, you can do so using, we have a hashtag GARP chapters. So I'd also ask that you please turn off all of your devices, or at least the sound on them. Better yet, just turn them off. Don't be disturbed by them. Anyway, our moderator for this evening is Lon O'Sullivan. Lon is Executive Director and Global Head of Corporate Credit Market Risk at Morgan Stanley. Prior to his current position, Lon spent a year as the Global Head of Operational Risk Management for Sales and Trading Division. From 2009 to 2013, he founded and led the Global Portfolio Analysis Group and was responsible for a briefing of senior management on all key market risk exposures and for measuring and managing the firm's market risk capital. Before leading the portfolio analysis team, Lon spent 3 years in Morgan Stanley's London office, where he built the regional analysis and reporting team. And prior to joining Morgan Stanley in 2005, Lon worked as a market risk manager in foreign exchange and commodity risk, and also as an equity derivatives product controller at Deutsche Bank. Lon started out earning his BS in economics at Binghamton University and his Master of Science in Finance from the London Business School. In 2005, he earned his FRM certification from GARP, and he served on the committee for GARP's professional chapter in London before coming here to New York. And since 2011, he has been co-director along with me here at the GARP's New York chapter. So please welcome Lon. Thank you very much.
Thanks very much, Stefan, and good evening to everyone. We're very happy that you're able to join us this evening in such a beautiful space. This is probably one of the nicest views I've ever had from up here. So this is, and I don't mean all of you, this is outside. Careers in Risk is an event that's usually one of the most widely attended of the year, and tonight seems to be no exception. Each year we try to make this as interesting and engaging look into building a successful career in risk management. And each year we focus on a specific lens of this important topic. This year that focus area will be on post-crisis risk management and how the role of the risk manager and the risk professional more broadly has evolved. Let me begin by introducing our esteemed panel. We try at GARP each year to bring together a set of individuals for this panel that represent different professional disciplines across the spectrum of risk management. This year, we're fortunate to have 5 individuals to my left, each of whom have a wealth of experience in risk management and the financial service industry more broadly. Starting on my left, Lee Marks. Lee's an executive director and is global head of operational risk for wealth management, investment management, and operations at Morgan Stanley. So he was a former colleague of mine, if you didn't pick up from my bio. Attilio Meucci is a founder of CIMIS, a risk and portfolio management education company. And in his spare time, he serves as the chief risk officer at KKR.
It's the other way around.
John Rogan is managing director and head of global banking and markets at Russell Reynolds Associates, a premier recruiting firm. Dr. Josh Rosenberg is a senior vice president and head of the risk analytics group at the Federal Reserve Bank of New York. And finally, Mike Shepton is a principal at Ernst & Young, focusing on financial services risk management. First, let me take time to thank each of you for taking time out of your busy schedules to be with us tonight. To kick off the discussion, I'd like to ask each of you to take a few minutes to share with the audience how you entered the world of risk management and discuss your educational background, your career progression, and your current roles and responsibilities. And if you feel so inclined, throw in a fun fact about yourself. So Lee, would you like to kick off for us?
Yes, thank you, Lon. I'm very pleased to be here. Firstly, just a bit about me. As Lon mentioned, Lee Marks, currently at Morgan Stanley. In terms of my career started out in finance, as you can probably tell, in the UK. Started in business and finance, and moved out of college into a finance role, leading a number of different programs and initiatives around mergers and acquisitions. And then Sarbanes-Oxley came along, and Sarbanes-Oxley was what transitioned me from being in a finance role and having some responsibilities from a SOX perspective to start looking at process risk and control. The SOX environment at the time was really intense and very active. I moved then to Barclays. Many of you will be familiar with Barclays. My role at Barclays when I first joined was global head of Sarbanes-Oxley for their wealth management business. I did that for a year. After that, I also took on a number of roles, the global risk COO for the wealth management business at Barclays, as well as the risk manager for the international private bank. And the international private bank, which is what got me on my travels. So from there, I then spent 6 months in Singapore, working in a number of regulatory initiatives. Back to the UK, shortly after that, I moved to the Middle East in Dubai. I was based in Dubai for a year. I had a number of roles out there. I was the COO for the Middle East and North Africa, as well as the head of risk management. So I established an operational risk function in the Middle East. Moved back to the UK, and then Barclays acquired Lehman Brothers. And that was a massive opportunity for me to move here to New York and to integrate what was Lehman Brothers' wealth management business into Barclays. So I did that and spent the first 2 years establishing an operational risk function within the Barclays wealth management business following the acquisition. Then I spent 2 years in operations, global head of risk and control for a number of operations functions, settlements, asset servicing, tax, and a bunch of other things. And then I joined Morgan Stanley in my current role. And my current role at Morgan Stanley, I'm part of the risk management team. I run risk management globally for their wealth management business, for the investment management business, and also supporting functions like operations, finance, and some other groups. In terms of fun fact, I'm not sure it's that fun, but I'm a Jets fan. I thought I would just let you all know that I'm going through severe
Definitely not
pain
fun this year.
Right now. But I am enduring it, and people do ask me a lot, having only been here for 6 years, why I chose the Jets. That's a really long conversation, so I'll move swiftly over to you.
All right, so Attilio Meucci, I have a quant background, PhD in math back in the 90s. Then I went to the industry right away. First consulting, I worked for Bain Company for 3 years. We would only do specialized quant advisory for asset management firms and pension funds. After 3 years of that, I moved to a hedge fund where I was the quant trader, kind of very small hedge fund, doing pretty much all that is quanti. A couple of years there, went to Lehman Brothers, stayed there 3 years until a month prior to the fall. Moved to Bloomberg, where I headed up the portfolio analytics research for the Bloomberg platform. Then went to a quant hedge fund as CRO. That was my first CRO role. I stayed there for 3 years. And then I went over to KKR, where I'm right now as Chief Risk Officer firm-wide. For those of you who are not familiar, KKR is a firm that originally grew out of the private equity business. It has about 60 billion under management on the private equity side. It now also has about 40 billion on the public side. And so the mandate is to cover risk across the board. And that's where I am. Fun fact, despite the many years, I still believe in risk.
Just a quick thing, I see a lot of people in the back. I mean, if there's plenty of free seats in the front here and to the side, if you want to take a seat, you don't have to stand for the whole hour and a half. John?
Good evening, everyone. John Rogan here. I'm a partner and head of our global banking practice at Russell Reynolds, one of the largest executive search firms. I also do the lion's share of our senior risk management work. I spend most of my time with the sell side, so with banks, securities firms. I've done a lot of work with the GSEs, and then into the hedge fund and private equity world, particularly with the growing debt market businesses you all have been building, which has required some new risk officers. We also do a fair amount of risk work with insurance companies, and particularly in this market where there's a lot of cross-pollination of talent from the sell side over to insurance companies. I've been involved in that. The types of work that we do and I've been involved in have been CROs, heads of market risk, head of operational risk, a lot going on in the liquidity risk world right now, and then also goes without saying in the board practice that we work on with establishing and bolstering the risk committee of the board.
Josh Rosenberg. I work at the Federal Reserve Bank of New York. I head the risk analytics group, which is part of the risk group at the Federal Reserve. We focus on risk management at the Federal Reserve Bank of New York, our own risk exposures. I should also comment that all of the views I expressed tonight are my own and don't necessarily reflect the views of the Federal Reserve Bank of New York or the Federal Reserve System. Just to give you a sense of my background, I have an undergraduate degree in math and religion from Oberlin College in Ohio. I got out of college and I didn't know exactly what I wanted to do. I knew I liked to build models, and I was a computer programmer and I enjoyed programming, so I started as a research assistant at the Federal Reserve Bank of Cleveland. I got to work with some economists there, got a sense that that economics might be a good way to put some of the tools and the models I was interested in learning to use. So after that, I kept doing modeling. I applied for a job out on the West Coast, and I worked in the equity modeling group at Barra. There I had the chance to work with Rob Engel, and a little later on I decided to apply for the PhD program at UC San Diego, where Rob was, and he was my PhD advisor. I got a PhD there, took the traditional track out of, after getting a PhD, and I looked for teaching jobs, and I ended up at NYU at the Stern School of Business teaching finance, which was great. Really enjoyed the job. Stayed there for a little while, and there was an opportunity at the Federal Reserve Bank of New York in the research group. So I sort of shifted over from being an academic, doing teaching and research, to doing internal consulting work and research, with the consulting being for the New York Fed. And then things got interesting during the financial crisis, and I think we'll be able to talk about that a little more in the next question. But during that time, I moved into the risk group.
Great. Thanks very much, Josh, and thank you all for joining today. My name is Mike Shepton. I'm a principal with Ernst & Young's Financial Services Risk Management Advisory Practice. My career in risk started kind of post-undergrad in the early 1990s. I majored in economics with a lot of exposure to math. So my first job in industry was in a bank, within a Japanese money center bank in the back office. And then from there, I was able to take my experience processing things like futures and swaps and swaptions trades into more the front office. And at that bank, I started working in the treasury desk around the funding of the bank and then taking some yield curve risk through some short-term proprietary interest rate trading. Then I moved and worked in 2 of the European banks in their rates and FX businesses, kind of as a market maker and a proprietary risk taker in kind of the junior part of my career. From there, I wasn't quite sure ultimately what I wanted to do, so I took a few years off and went to business school and then undertook an MBA in finance. And really from there, I sort of discovered that I really did like kind of case-based work, project-based work, and really problem solving. So that's when I thought that perhaps advisory might be a nice career path for me, where we were kind of working to solve problems for clients. So from there, I moved into Ernst & Young, and I've been with Ernst & Young for about 15 years now, where currently I help lead a lot of our market risk, counterparty credit risk, and treasury services, working with many large banks primarily, but also kind of buy-side and insurance companies around their kind of risk organization, their risk infrastructure, anything from risk appetite and limit infrastructures to kind of capital and liquidity risk management, and also how do they optimize their balance sheets. So I look forward to speaking to you today. A quick fun fact is that I am not just a FRM GARP spokesperson today, but I'm also a member. And I am a member, and I am an FRM attainee, class of '99, so I highly recommend the exam. Shameless plug noted, but I found it very useful in my career in risk. Thanks.
Thanks all for that. Josh nicely primed me for the next question, which rarely happens when you're the moderator. This is great. Following on from the introductions, I thought I'd take a minute to ask a couple of the panelists maybe about some of the notable milestones or potential mishaps that may have happened in their career and how that's kind of propelled their career or held them back and helped in the end to shape the success all these gentlemen have. I think I'll ask this question to both Lee and Josh, and perhaps Josh, lost Mike. Perhaps Josh, you can start.
Oh, sure, I'd be happy to. So I was very happy in my role doing academic research, part-time, and in the research group, and also doing internal consulting work, and then the financial crisis came along, and a lot of us at the New York Fed were asked to apply tools and techniques that we had to a lot of new problems involving market risk management and credit risk management. And because of my background, I started to do a lot of financial crisis-related work. I worked on developing haircuts for the TALF program. I worked on the CPFF, the Commercial Paper Funding Facility program. And as I started doing more and more of this work, in addition to doing weekly briefings for President Geithner, it was amazing to work with, both the time I had to do academic research and my interests started to shift over and become even more applied. At the same time, the bank recognized that it needed to refocus the way it was managing its own risk as its risk profile changed, as market and credit risk became something which was really, a day-to-day issue. And so my boss now, Sandy Krieger, created a risk group, and she needed staff. She needed someone to lead a risk analytics area. And so that's the area I run now, and we do 3 things. We build models. We validate models, not the ones we build, but other models in the bank. We also do independent price verification. And so I was interested in this new management challenge and also the technical challenges associated with it. I will say something which I didn't have. I was looking at my remarks from last year, but we're now kind of post-crisis. So, for the Fed, our portfolio of exposures changed with the crisis. And it changed again as things have wound down. And now my job and my role has changed somewhat also. And I'm looking at other risks, including things like operational risk, because the focus on market and credit risk has shifted a little bit. So the world has changed, and we've had to adapt to it.
Yeah, and I would just add, from my experience, and I'm trying to think of milestones, I'm thinking more of mishaps, but from my experience, I would say cultural integration has been a big part of my career because of so many moves in so many different jurisdictions. I just think when I moved to Dubai, for example, the Arabic culture was very different, not just the fact the weekend was Friday and Saturday, but just the way in which they work, the way in which they think about risk issues, the way they communicate is very different to, say, how we would in New York or in London. Similarly, when I first came to New York after the acquisition of Lehman Brothers, a really big learning curve for me, and something where I had to adjust pretty quickly was appreciating what people had been through in the Lehman Brothers organization. I came from London, I was part of the Barclays team, I was going to integrate Lehman Brothers, we were all gung-ho, this was a new acquisition. The people that had just been acquired had been through a bankruptcy, they'd been through hell in the 2 years prior to that. So I had to very quickly adjust and really, for the first month or two, just really listen and just allow people to really just talk about the stories, the journey they'd been on, and then to slowly start integrating them into what Barclays was going to bring to the table and how Barclays was going to try and build a path for the future. So that was a huge learning curve for me and something I needed to adjust to quickly, because clearly in a sensitive time like that, if you make too many errors, then quickly you lose trust and it becomes very difficult. And then just the other one I would make that stands out for me, I think generally about risk management, is communicating with different levels of the organization and being able to give the right message to the right audience. Just through my career, and I think about the different audience I've had, whether it be risk committees, board of directors, or more junior people that need to actually execute the control, I think it's really key from a risk management perspective to be able to shape the message and the content and the delivery to the people that are trying to understand it and execute on that. And a good example of that would be the board. The board of directors today are getting so much pressure from the regulators and from others to take a much more active role in making business decisions. And what they need in order to do that is information that's synthesized and that's presented in a certain way. So, yeah, I think that's been something from my career. I definitely remember a number of mishaps where I didn't get that right. The information was at the table, therefore decisions couldn't be made. So that's definitely something that I've learned through my career.
That's fantastic. Thanks for that. Shifting gears a little bit. So most of the people in the audience here are typically fitting into one of two buckets. Either you're a student looking for a new opportunity, or you're an experienced risk manager. And I think this question could apply to both. So I guess the question is, what do we think this panel thinks makes an effective risk manager? And when you're making your key hiring decisions, what are the core qualities or attributes that you are all looking for, and how do you prioritize amongst these attributes when you're making your hiring decisions? Mike, why don't we start with you?
Sure. Thanks, Lon. I think, a lot of our interest is sort of dependent on what level people come at, but I would say twofold. One is people who are kind of new to risk and not really changing within the risk spectrum, but new to it. We just definitely look for a lot of intellectual curiosity about the role, about the risk function. I think people who are inherently interested in kind of why and how things work really do well in an environment of risk management where you have to identify, measure, and manage risk. So more at the inexperienced level, we look really for a lot of native intellectual curiosity about the topic, and we're a little bit less concerned about their specific coursework, but it's really just showing that interest. I would say more at the mid-level, people either transitioning into the role, mid-career, is definitely a little bit more on the qualitative side, is more of kind of, we're looking for examples of leadership where people have kind of led initiatives. So within E&Y, we do a lot of work on organizational change and helping our clients implement new processes or new regulations. So we really want to make sure people there have great communication skills and a real structured way of thinking and processing problems. And so a lot of it is kind of how they think about things holistically, how they look at organizations and how they're organized and can communicate change is what we look for more at the mid-level.
Leo, any thoughts?
My side. Well, so right now to put some background. So the team is divided. I divided the team into two parts. One is the analytics people. The other one is the frontline people, quote unquote frontline or business line. So analytics people are the people who build up the platform that measures the different risk measures that are around, and that includes liquidity. It includes all sorts of generalized risk measures. The business line, frontline people are people that are tightly embedded in a given vehicle, say hedge fund versus loan-only credit versus long-short equity versus different business lines. So on the analytics side, basically the requirement is, I would call it mathematical maturity. And I use it as a quote-unquote, meaning that there's an entry on Wikipedia. You can just Google up mathematical maturity, look up what it says. That's what is required.
Just don't do that right now.
Just not right now. I'll go back to that in a sec. On the frontline team, basically it's experience with a quantity flavor, but with a quantity penchant, but nothing beats experience. And this is pretty much the set of requirement. Now, to go back to the mathematical maturity, it's pretty much the ability to. I'm kind of reluctant to talk about it right now because it sounds too vague, but it's the ability to abstract, the ability to draw a common principle, the ability to communicate in clear, terse notation. And as quants, we have this great advantage to be able to communicate very quickly with very dense formulas, and so I like to keep that going that way.
Lee, any thoughts?
Yeah, I think first, and just building on from what Attila was just saying, communication skills would be my number one. I think operational risk, which is mainly my background, communication skills are so essential because you're always walking that fine line between being independent and building trust and relationships within the business. And that isn't an easy role. So being able to walk that fine line, build those relationships, which essentially you need to leverage in order to get the transparency into the organization so that you actually can understand what's happening. But at the same time, being independent and at times having to make a hard call as to whether or not you agree with something or whether or not you have a different view, I think is absolutely key. And then second to that, I think an understanding of the business and products. Clearly at different levels that will differ. I think as you get to the more senior levels, that's definitely expected when you're making strategic decisions. But I think in order for us to be able to make informed risk decisions and for us to be able to provide input, we need to understand the context in which we're looking at those issues within. So I think that's also pretty key.
So I've heard both quantitative and qualitative spoken. I guess now is the mix of those two. And when we think about how much quant versus how much qualitative and I guess judgment, how do we think about benchmarking those, particularly in an interview fashion, which is quite a bit harder to extract from that kind of a setting? So perhaps Josh, why don't we start with you and see if you have any thoughts about how first do you measure those two together, and then how do you try to extract them as you're going through your interview process to see who are your best candidates?
Yeah, that's a good question, Lon. I mean, I'd start by saying we recently went through in my area an interesting exercise trying to think about what skills are associated with different levels, different roles as the levels get higher up, and we also did some comparisons to other areas. In fact, we were looking at a more policy-oriented group, and it was interesting to see how in our stream the quant skills start out really at the entry level, and then as you go up, as others have mentioned, the communication skills become more important. I think that it's a little bit easier, I suppose, in a personal interview situation for me to get a sense for the communication skills and someone's personal style. Certainly a lot around the communication skills is that ability to be an active listener, to have a good dialogue, because we do have to wear multiple hats and really actually listen to what other people say. It's not just the ability to be persuasive and communicate clearly. So I think I'm looking for both of those things, both at a higher level, at a more senior level, which would be both being articulate but also being able to listen and have some give and take. On the quant side, I'm not looking for usually, especially at the lower levels, a set of specific skills they've mastered. It's more the intellectual curiosity and ability to take technical concepts and translate them into practice. So there I'm just looking for somebody who's showing that through their ability to both ask and answer questions. I don't think we have a particular process to extract that. I think it's a little bit more art than science for us now.
Mike, any more science on your side?
I think it depends a little bit case by case on what we're interviewing for. So within our practice, we do have some dedicated quantitative modeling skill sets that might primarily be focused on a little bit more rigor around their math or engineering background. But I do think generally, along like the way I think we would try to handle understanding someone's competency to help our clients would be more of a behavioral question and how they would get to the answer. So, for example, we might ask someone, again, not necessarily the most technical question, but, hypothetically, if you were working with a client and you had to implement a certain types of potential exposure model for counterparty credit risk, how would you proceed to organize and structure a team to implement it? And I would be more interested in hearing how they would get to the answer. So they might quantitatively have some really good understanding of simulation methodologies and PFE modeling, or they might understand that they would have to bring in the right team to solve that problem. And I'd be of equal interest in how they get there. So I think as long as on balance they show that kind of thoughtful process that they know they need a comprehensive team would be kind of the way I would want someone to complement their quantitative and qualitative skill sets in a response to demonstrate at least the awareness of the side that they're not maybe focused on themselves.
Makes sense. When I was preparing for this, I'd done some research on the web and was just looking for kind of papers or other things that were written on this topic. I came across a paper on tapestrynetworks.com, and this was a paper that they had published back in 2012. I just wanted to read an excerpt for you, and then we'll turn to the panel. CROs, Chief Risk Officers, those that don't know the acronym, need a mix of skills that enable them to properly manage the risks facing the firm in a way that enables gainful risk-taking. One supervisor said that the Chief Risk Officer needs to be both a scientist, and a poet. You need to be quite nerdy to understand this stuff, but you also need to be able to tell a compelling narrative to people who are less qualified in that narrow focus. So some of that was already said in the panel. I guess the question I want to ask John here is, John, in the work that you've done in placing board members, C-level executives, etc., have you seen cases where executives are differentiated by their ability to be both nerds and poets, and where are you seeing the trend now in this kind of post-crisis world?
Okay, so I'm the headhunter, so I get to see all the good stuff. So let me start just one little factoid, which will then segue into, I think, some skill base that we're seeing being fairly consistent in the most senior risk officers, whether it be across market, operational, credit, balance sheet risk, et cetera. So I did just very back of the envelope research on the top 50 banks by asset size in the world right now. And from 2008 to present, 76 of those CROs have been appointed since 2008. Okay, so that's a pretty huge turnover. Maybe not surprising for a lot of people. Of that group, 71% of those sitting CROs now had some type of general management experience beyond risk. What I mean by general management, they were in a business unit or outside of risk, which that number I intuitively have seen the senior risk officers have some type of, we want a business person in the role, but obviously there's a lot of terrific people that grew up in risk that also migrated from a regional or a deputy risk officer into the CRO role also. But I was actually a little bit floored with the amount of people sitting in senior risk roles now that had some type of business management role outside of risk. Just so you know, for the ones that did have some type of risk experience within this 50 largest asset banks, 62% of them have a credit background, 24% have market risk background, and 10-12% had some type of operational risk background. So I can't say historically. I think obviously there's more experience on the panel here, but there was a shift from credit to market risk, and I think credit has come back as perhaps a prevailing experience base for some of the key roles. And again, that's just in the banks I was talking about. So in terms of career progression, it's hard for people that are mid or other parts of their career to go back and say, well, I wish I can do this. But if there are people earlier in their career here, I think what I'm trying to say is that when we are evaluating now senior risk officers for our clients, we are looking for someone that has spent some time out of risk. And I don't know if it's easy to manage your career like that, but I think if possible, to try to raise your hand and say, I would like some time outside of risk with the intent of coming back to risk. And I think also senior managers, including probably on the panel, also have identified high potential risk officers for grooming and have moved them out of risk. I think people would agree with that, and brought them back with risk as a good experience. So that's number one. Some non-risk experience has become key. Two, and I'm going to state the obvious here, some type of global or international experience really sets people apart. We don't have many of the key roles that we're seeing that I would say are, not going to say it never happens, domestic only, some type of touch point to a global platform. Global product line doesn't mean you have to leave New York and move outside of the country, but some type of global product group would be key. Echoing my panel members, probably paramount is the communication skills. But I would also say that that goes much more into what I call influencing skills these days. So I think most people here know it's not a yes-no decision-making market right now. When I think the market risk function, which I don't want to be stereotypical, it's typically more of a quantitative-driven function, because the market risk function is so much more tied into balance sheet liquidity risk management, the partnering with the CFO, and how all that gets to stress test level is just, you can't be in a silo within the market risk function right now, and that requires a greater level of communication influencing skills. I think those, we can handle some of this later for the Q&A, but I think those, the non-risk experience, as I say to a risk group, some type of global product experience and/or international experience, and the influencing skills are what we're looking for the most.
Interesting statistic on the CRO being 62% credit. That's interesting.
Yep.
Kind of leads me to a point about, that's interesting at the CRO level. What about more broadly? Where are the hotspots at the different levels in risk management now? Is credit risk kind of the new hotspot, operational risk, liquidity risk? Where are you seeing a lot of the flows in the industry right now?
So some of the areas, and again, we're just one search firm, and we see a lot of the market, but sometimes see what our clients are talking to us about. So there's probably collectively as much recruiting experience on the panel here than just me. I did meant in my introduction, I've been at Russell Reynolds 27 years now, so I joined when I was 14, but all that good stuff. So, the headhunter who can't find a job. So a new segment of risk, which I don't want to sound profound about it, but the whole area of having more dedicated people to the liquidity. And again, I spent a lot of my time with the banks, so if I'm sounding bank-centric, I apologize about that. But a lot about balance sheet, liquidity, risk management, and that is not something that has been naturally homegrown, so it's actually turned into a recruiting market of trying to move some people around. That's been a very active area. The one area that's become, until you KKR, you can like that, the whole non-bank market, particularly in the private debt markets, the emergence of the BDC market, I'd say one of the more active areas in risk management that we've seen is in this whole area of middle market finance. There's a lot going on in the middle market. Leverage finance is back. No gasp from the risk crowd here. So there's a lot going on in that area. I'd say we, back to that 71% of the chief risk officer of the banks turning over since 2008, about 100% of the insurance CROs have turned over in that same period. If there's an about 100%. So one of the things we're seeing, and I'm not an insurance, but one of the things we're seeing within the insurance risk market is a lot of reaching into sell side, into the securities firms to bring, I don't want to say that there's been less talent in the risk on the insurance market, but bring in talent from outside of insurance into the insurance market. There's a lot of activity going on in risk recruiting within insurance companies, a lot. So if people are thinking about their career, repositioning their career, there's a lot of activity going on in the insurance market. I would say, well, Josh would know more. I think that even the regulators are reaching into people from the private sector to come across more than I've seen in the past for talent. Not that, and also, the consulting firms are there. So. No surprise. I mean, there's a lot of activity, and it just seems nonstop with people looking for risk talent.
Last question on careers, and then we'll move on to some other topics. Relating to building a career, we've talked about quantitative versus qualitative, a number of other dimensions. How important is the formal education piece relative to the on-the-job training? And Attilio, maybe you can start us off, and perhaps when you're answering, you can maybe discuss the boot camp course that you run and how that might relate to your
I'll plug later.
Selection process.
Thanks. So, as the official educator, how well it matters, the education. I would say the formal education, I would say, and then let's analyze it one step further, doesn't matter that much. As long as you don't take what you learn on the job as your education. So it's neither nor. Basically, going back to what Lon said, it's if the choice is your formal education versus what you learn on the job, you're going to be left empty-handed. So you want to always react to what you learn in your formal education gives you the frame of mind. That's all it gives you. What you learn on the job, you can learn recipes on the job, or you can embed the frustration in your soul, react to it, and try very hard to understand the why behind the things that you do. So if you do that, that reaction is what creates your professional depth. So again, it's not what you learn in school, it's not the recipes that you see every day, it's trying to dissect those recipes, understand deeper where they're coming from, what are the common thread with things that you've seen in your previous job and things that you will use in your next job. And always try very hard to make it hard for yourself instead of make it easier for yourself. So that's education. And that's what I think pays off, hopefully. Is it too vague?
Definitely one of the more interesting responses to that question that I've had in my career. Quite interesting. Lee, what are your thoughts?
Yeah, that's quite a hard one to follow on from. But depth of the heart, was it?
And a whole bunch of other kind of interesting.
But yeah, I think they're both critical. I think the college education really is key in terms of, I think, providing foundational knowledge. I think people who are successful in the college environment clearly are very focused. I think it does give some discipline. But it's the start. At the end of the day, it's the start of the career, and the on-the-job training is really what then shapes that. And I think something which Attila was referring to, which I think is extremely on point, is it's really then what you do with that knowledge, how the extent to which you then want to develop that within the organization you're in. And in many organizations today, there's so much opportunity to continue to learn, both in the job you're doing, within the function you're in more broadly, as well as the programs, the educational programs they have in the firms we work in. It's really up to us to drive our own learning. So I think they're both key, and I think it's something that people need to strive to on an ongoing basis. I would mention that some types of, when we say formal education, we naturally think about college, but I would also say that, not just plugging FRM, but also CPA types qualifications, Series 7, other qualifications that we do during the workload. When I first got here to New York, within the first 4 weeks, I did the Series 7 because I needed to understand what the Americans were talking about with the types of products and everything else they have here, which was very different to the UK. So it is also very important as risk managers, coming back to my prior point about understanding the context in which we're having the discussions and providing our view, that we have the knowledge in order to do that. So I think the formal education piece also isn't just, I think at the beginning of your career, I think it's something people should look at on an ongoing basis to continue to learn in both domains.
So let's shift gears and talk a bit about the financial crisis and some of the leading challenges of the crisis. So one of the failures that's been observed of risk managers in the financial industry more broadly really related to the extensive use of modeling and assumptions that proved to be inaccurate. When reflecting back on that period, how do you think it influences your judgment and actions as a risk manager today? And Mike, maybe I can turn it over to you to start.
Sure. Thanks, Lon. I think, when I look at how both regulators and banks have responded to the fact that, during the crisis, banks were not as well capitalized and basically hadn't been modeling liquidity. So there was all this insolvency risk that really wasn't provisioned for. Like Lon said, both regulators and banks had to reassess how they were measuring and modeling work, including the assumptions. I think there has been kind of two broad responses that I've seen both clients from a management standpoint and regulators take. One is definitely in some cases to not solely rely, but basically to kind of supplement models, but not necessarily throw them away. So, for example, in the world of market risk, one of the primary measures people look at is value at risk, and for a portfolio in a trading book, they would look at the P&L distribution, but you're very reliant to a look-back period. You're very reliant on distributional assumptions, depending on your modeling approach, and that definitely hasn't gone away. But I think people have definitely sort of supplemented that a bit more. So the regulators said, okay, this isn't calibrated to stress. Let's actually have a stress calibration, so it's less pro-cyclic. I would say that banks and regulators have said, okay, VAR is still useful, but let's also kind of supplement it with stress testing. That's something that's a little bit more deterministic, that I'm not solely reliant upon modeled assumptions or look-back periods in and of themselves. It helps me explore tail risk. So I think models, again, are still an important part of the risk management tool set, but I think they're, again, being used in tandem with more deterministic tools such as stress testing. And if you look at the whole CCAR exercise, that's foremost but not entirely a deterministic based approach, but then it increases use of models. So I think the second piece, though, is now using the models themselves. What we've seen, again, probably both in the regulatory response and clients is really just increased rigor around the usage of models. And I would say it manifests itself in a few ways. One is people now are challenging the assumptions, the models a bit more. So as part of the supervisory framework, there's something called SR 11-7, which is kind of the supervisory model guidance supervisory guidance on models. A big part of that framework now is effective challenge. And really don't just take the assumption as given, but modify it, adjust it, look at it. A lot of firms have kind of more model validation working groups and stress testing assumption working groups that are actually external to the model owners that help provide effective challenge on why did you pick that distribution? What is that runoff rate? What is that based on? And so people are bringing in that challenge. I think an important point that Lee raised is when we see the use of models, there's much more involvement with the business now in terms of the appropriateness of a risk model. Historically, I think risk managers may have been working a little bit more in isolation of the business. Now, as part of a model governance framework, you'll have not only the model methodology quantitative people, but you'll have more engagement with the business to assume if it's fit for purpose. You'll have more engagement with process and controls and data experts to make sure that the data is appropriate and controlled so that the inputs to the models are really appropriate. So again, I think aside from complementing or supplementing, I'll never get the right word is distributional models with stress testing. I do think there's more controls around the model validation framework. There's more use of challenger models, and there's more use of data quality controls to make sure that the inputs to the models are correct. And so I don't think models have gone away. I think they've just been used a little bit differently, and there's more governance around the whole model process.
Any other comments?
Yeah, if I may interject on the to complement and supplement on the buy side perspective, there is I've seen quite a lot of blending of the something that John mentioned on the role. So one used to think of finance as one function, risk as one function, portfolio management as one function. But in reality, the role of the risk manager on the buy side is very tightly blended with the portfolio management role, and that probably is obvious to a few of you. Something that might not be as obvious is that it's also tightly blended with the role of the finance team and CFO kind of reporting line. The reason being that if you think about it, risk is about swings in value. And so especially in the liquid markets, there's a large, very deep quantitative literature on assigning a value to things that don't have a value. So valuing, the exercise of valuing, fair valuation, is paramount on the illiquid side of the buy side. And so there's a deep connection with the finance team from the risk management. So finance, valuation, risk management, swings in value, and optimization of the swings, that's portfolio management. So again, swings in value, which is risk, how to optimize them, that's portfolio management, and how to measure them, and that's valuation. And this new spectrum of boundaries, it's fairly new, and at least it was new to me, so I was pleasantly surprised that the role is expanding, not shrinking.
One of the things that struck me about Josh's opening remarks were kind of talking about early in his career focusing on market risk, credit risk, and as of late, spending more time thinking about the operational risk world. And I think, if I may, that actually sounds very similar to what I hear in many financial institutions, that really the paramount of most risk organizations historically has been focusing on market risk, credit risk, liquidity risk, and only recently in the last 5-10 years or so is operational risk becoming more of a central risk that firms are looking to measure and manage. Some of you may not be familiar with operational risk and what it means, so I thought I'd give you a sense by way of example. If any of you have heard of the JP Morgan London Whale incident, the SAC Capital insider trading incident, various multi-billion-dollar settlements focused on mortgage abuses that have come out of the financial crisis, the variety of AML fines levied across a variety of firms, LIBOR and FX rigging, theft of confidential information at Target and JP Morgan and others. Unfortunately, the list goes on and on. If you've heard about any of these types of issues, this is a good segue into understanding what operational risk is. And you've heard the divergence of different types of risk that falls under the umbrella of operational risk. So given that we are fortunate to have a seasoned operational risk manager on the panel, I thought it would be instructive to ask him to share his thoughts a little bit about the risk and about what the industry as a whole is doing to think about how to measure and manage this new and more complex type of risk. Lee?
Yeah, thanks, Lon. So that's a pretty tough question. So if I just think about my career, so I've been doing operational risk now for, I think, between 10 and 12 years, and the level of regulatory focus and definition around operational risk as a profession and also as a concept within organizations has just continued to progress and mature. And I really feel, and one of the things that I've discussed a lot with some of my peers and other colleagues is credit and market risk are quite mature. I think over the last 2 or 3 decades, I think have really become a mature concept that people understand, very quantitative. Operational risk has been a little bit of kind of an unknown, and I think more and more what we've seen, especially in the last 2 or 3 years, is a real definition around operational risk. And as a result of that, I think the banks are extremely focused and needing to be very focused on their operational risk framework. One, because it's driving so much of their capital requirements. It's really very significant in terms of the operational risk capital requirement, and it's getting to a point now where it's comparable to what we're seeing with market and credit risk. And as a result of the drive from the regulators to have a framework that enables you to determine the right level of capital to hold on your balance sheet, there's a whole lot of complexity that's required within the organization in terms of frameworks, in terms of how embedded operational risk management is, the role of the board, and that's something which all of the banks, the big banks out there, are very focused on different levels of maturity. But I would say, just moving a little bit more into some of the details, some of the specific concepts that I see that are very prevalent right now. So firstly, the regulators are talking a lot about embeddedness. They're talking a lot about the organizations needing to have operational risk as a concept embedded within the organization. People who are in the front office actually taking the risk, booking the trade, who are actually responsible for oversight and supervision day to day, executing controls, absolutely critical that they understand operational risk. When we look at some of the examples Lon just mentioned, some of the unauthorized trading, issues around anti-money laundering, the $9.6 billion fine that BNP had, all the way through to natural disasters like Sandy. This is all operational risk. Everything outside of market and credit falls into operational risk. So embeddedness and awareness within the organization is absolutely key, and something that organizations are really striving to implement. And part of doing that as well is having a robust framework. And again, conceptually, some of this is quite new to organizations, which is half of the challenge. So many of you will be familiar with the concept of capturing issues in an organization, incidents, losses that are occurring, which is enabling an organization to understand a number of things. Firstly, do we understand the issues that are occurring in our own organization? I've been part of organizations before where the management team doesn't actually know that the trade has just lost $1 million, and over the course of the last 3 months has actually lost $50 million. So having transparency through governance, knowing your control issues, where your weaknesses are, is really, really key. So that's kind of one pillar in terms of understanding your internal losses. Secondly, in terms of what's going on in the industry, one of the things organizations are being really pushed on is, to what extent are you looking at the environment, you're looking at the incidents that are occurring. We've mentioned, and Lon mentioned some of them there, but the big fines we see in the industry today, and looking at those in the context of your own organization. Could these occur within your own organization? And if so, what would the impact be? How would you react to them? And then lastly, I would just mention the real drive, and we've touched a few times on the importance of the board. And I mentioned previously the communication piece. A real big focus is making sure that the framework, the embeddedness of operational risk and understanding is really driven from the tone at the top, and is really a lot of the accountability, especially in Europe with the PRA, is being placed more and more on the board members, who ultimately are making the strategic decisions for the firm. So having a framework that allows you to understand your risks, being able to utilize that framework to present to the board a concise view of the risk profile, the types of risks you're taking within your organization, strategically decisions you can make going forward, and understanding how that then directly impacts your capital that you're having to hold on your balance sheet, which is very significant and growing, is really all key. It's all under the umbrella of operational risk. So I'll pause there. I've dotted around a little bit, but it's a broad question. I could have answered that in like 100 different ways. Any other
more difficult
comments?
questions? Any other thoughts on the panel? Or we can move on.
Yeah, I mean, just a few points that I've seen. Ops risk really is so comprehensive, because even though right now we're describing it outside the context of market and credit, very often ops risk can lead to market and credit. So we just also it really is an all-encompassing risk. So, for example, someone fat fingers a trade and puts in and buys a sell, they don't catch it, and the market moves against them. That happens a lot. And all of a sudden, an operational risk fail just cost your trading book $50 million. Or similarly, I worked on a settlement risk case once where a bank absolutely knew it had exposure to Lehman Brothers, forgot to put in a halt payment to its FX payment system, and accidentally let a bunch of money go out the door to Lehman, and it was forever gone. So ops risk led to credit and settlement risk. And so it really is possibly the most all-encompassing that I just want to make sure we think of it not only as very widespread, but also inclusive of market and credit risk as well.
Yep, absolutely.
That's actually also, I know I'm not a panelist, but I guess I have the podium so I could say what I like. I think that's an interesting thing as an industry as a whole. Where does operational risk sit in the C-level structure? Because at some places that would sit in kind of a legal and compliance type risk, operational risk. At other places it actually sits within the risk organization. So I think as an industry, we're trying to harmonize on what is the kind of the right place and what is the right home given the interconnectedness of operational risks amongst the other risk types. So just a segue.
I had one thing to add to that, which is I think there are two related issues for us. One of them is one of the risk types we look at now is strategic risk, which is risk of not meeting the strategic objectives of the organization, and that can tie a lot of these risks together. It takes you out of the market, credit, operational risk, and you can have things that are combinations of those which impact your strategic objectives. And I think the second challenge with market credit operational risk is to figure out in a risk organization how to integrate those things together and then be able to bring them and articulate them to the board in a way that isn't so narrow and isn't defined in terms of the way we found it convenient to divide up our specialties, but rather reflects the true overall risk that the organization faces. So I think there's some very interesting challenges in integrating the risks together.
So Lee mentioned a couple of times in his comments about the regulators and the regulatory environment and how a lot of the things the industry is doing around operational risk, or some of it at least, is regulatory driven. So I thought I would segue the last part of the conversation before I open it to Q&A from the audience into the regulatory landscape. As we all know, regulators globally have been tasked with monitoring and mitigating systemic risk for the global macroeconomy. Given this mandate, a variety of regulators around the world have increased their spectrum of responsibilities as well as the tools at their disposal to attempt this very challenging task of guarding the macroeconomy. For instance, just yesterday, the EBA released the results of a stress test that it's performed over the last year against 123 European banks. And of those 123, 24 have failed the test. And 14 of those 24 need to raise additional capital within 9 months, or they could be forced to close down. In the U.S., we have a similar type of a stress test. Many of you would know it, called CCAR. Josh, being the regulator on the panel, I was wondering if you could talk a little bit about some of the tools that the regulators are using to manage systemic risk, and particularly in the Fed, since that's the institution you represent.
Sure. Well, so I'll just speak to my personal experience and my role with respect to the CCAR process. So my team has several responsibilities, and we're involved every year in the annual CCAR process. One of them is we build some of the models that are used for assessing potential losses. So that kind of work requires both a combination of modeling skills and expertise in the particular securities classes. Mm-hmm. So that's one of the things we do. A second thing we do is we participate in a system-wide validation of the models that are used in CCAR. So model validation is very much central to the work that we do, both in terms of the models that we look at within the bank and also the models the system uses for CCAR. So that's a structured process that involves looking at the conceptual validity and the assumptions behind the model, but also looks at the implementation of the model, looking at things like data, looking at things like the coding and the process for the data flowing through the code and going from the beginning to the end. So then the third thing we do is we also look at the bank models that they use in order to do their own estimates of losses. So that requires subject matter expertise and a lot of engagement with the banks. And so that's another level of model review that we're involved in. I mean, from the perspective of a jobs, a careers related panel, all of the work that we do requires both a technical expertise in terms of knowledge of the underlying models, in terms of knowledge of the asset classes, but also a lot of ability to communicate and dialogue with either model builders, whether they're at banks or whether they're internal to our organization, and the ability to work as part of a very complex process with many people and many stages. So I think this work draws on a lot of skills, and I think those are some of the kinds of things that folks could think about building in their own portfolios of skills.
Mike, can you share with us some thoughts about how the industry is responding to this increasing and ever-changing regulatory environment, and how is the industry responding to a lot of the new tools that the Fed and other global regulators are asking us to adhere to?
Sure, Lon. I mean, I think in general, both the U.S. banks and the foreign banks have definitely recognized that addressing regulatory change has to be a core competency. So over the last several years, definitely many of the leading banks have really assembled cross-functional teams and have embedded also within the businesses people who have to be really involved with not only the business, but risk, finance, treasury, tech, and ops, and really be able to assemble teams very cross-functionally quickly to do things like impact analysis, really quickly assess what is going to be the impact on my business today, what is it going to be in 2 or 3 years from now, should I be de-risking, should I be repositioning. So I think there's definitely much more teaming across firms now, where firms acknowledge that for any individual reg, they have to identify stakeholders and get on the same page organizationally quickly to be able to address the reg change, but also the business impacts. I think a lot of banks have started to develop more kind of core what I call kind of internal consulting or change the bank core competencies, and also using firms such as myself as well. But they've recognized that changing the bank is really very important in and of itself, and we can't just always rely on the run the bank resources. So very often, though, now they've realized that they have to get the core people within the lines of businesses or within the functions knowledgeable quickly, and then either backfill them and move them into projects, or have a dedicated organization around change. So I think again, strategic change is becoming more of a business as usual function as opposed to just special projects. I think at individual regulations, definitely most banks are following a typical life cycle of a quick impact study, a gap analysis, a project roadmap, and an implementation plan. And then I think some firms are looking at so many changes at once that they also have to look at bank-wide programs, like what are the interdependencies across my programs? What is the strategic design of future architecture or data for the firm? Because why would we want to go at these things in a piecemeal manner? Mm-hmm. So you're starting to see more firms have like a 5-year-plus roadmap in terms of how do these all fit together, and then kind of individual pieces looking at this in an integrated way.
And it sounds like a lot more kind of project management and being much more connected with the rest of the organization, not just siloed to the risk organization. So I guess, John, from your perspective, is that changing the profile of a typical risk management hire? Are we moving more towards different kinds of people that can manage not only the more technical and quantitative aspects, but also the regulatory relationship angle and the project management and all of that?
Well, I'm not going to say it changes the skill base, other than, again, stating the obvious, that I'd say say CRO or direct reports to CROs, maybe even a level down from that, but particularly at that level, the people that I meet with, talk to, interview, assess, are spending north of 50% of their time on regulatory issues. And I won't give you commentary of it's no fun anymore in the job, but it is it's a requirement. And I think when I'm interviewing or assessing candidates on behalf of our clients, the days of going through the interview, so you got any regulatory experience? Oh yeah, like that. We're getting very specific about what do you do, who do you interact with, which regulatory body, which there are obviously more than one. I don't want to say we get on a name-by-name basis who would know you, and that's at the starting at the director level, not just the MD, and then more the management level. We're getting very specific. Our clients are asking us not to be as very rigorous in terms of you should be prepared, not just through recruiters or any type of job interview, about what role did you play, because everyone wants to know. It's a requirement of beyond your functional skill base and your experience skill base. So I guess the point, Lon, what I'm saying is that our interviewing or assessing candidates, we're actually getting a real deep dive on what exactly is your regulatory experience, and with whom, when, how, and we're getting into a fair amount of detail. When I wouldn't say we just blew it over in the past, but it's as important as any of the other skills you're bringing to a potential employer.
Great. So I think that will round out the prepared part of the panel. I'll leave it for the Q&A, which you've all been anxiously waiting for. Just want to lay a couple of ground rules. This is Q&A, and we're trying to get as many people to ask their questions as possible. So I just ask you to keep your questions brief, 2 or 3 sentences. Don't go on and on. We've had scenarios in the past where people go on and on. If that happens, I'll have to cut you off and move on to the next person. So try to keep it brief and informative for the group. So I think we should have some microphones going around. We have one here and one here. So if you just raise your hand.
Can I just first
Please.
ask the audience a question about yourselves? I always like to map the audience. So I'd like to understand you guys. First, within risk, I will branch you into 4 categories, let's say. So there's the 3 areas of money. One is banks, one is asset management, one is kind of pension, ALM kind of stuff. So banks, buy-side asset management or pension funds. The 4th one, I call it consulting, and that includes academics, includes anybody who has a broader perspective and not a direct management of risk. So these categories, banks, asset management, pension funds, and consultants. So banks, raise your hands. Okay, asset management, raise your hands. Pension funds, no one. And consulting, including academic, raise your hands. Okay, so mostly banks. All right, and now just for my pure curiosity, quants versus non-quants. So let's define quants. Quants are those who fear not an integral or a derivative, right? Not those who can do fast operations. That's a different story. That's accounting. We're talking about integrals and derivatives. Those who don't fear those and matrices. Raise your hand if you're a quant. Okay, the rest is non-quant. Okay, thank you. Sorry about that.
Okay. First question.
Hi, I'm Barry Miller, Pace University Career Services. As you can tell, we have a lot of students here, and they're interested in what you recruit for on campus. What do you look for? Be more specific than good people, and good communication. Just what areas you recruit for, and what you look for in terms of core competencies.
Is that for anyone in particular, or just in general?
I think there's four people that are probably recruit on campus.
So we have, Josh, we have our recruiters here tonight who folks can speak to. So the Federal Reserve Bank of New York has a table, so I invite anyone who's interested to please visit the table. Again, if you're just talking about undergrads, grad students? Oh, okay, and MBAs. So at the undergrad level, quantitative background, whether that's math, econ, statistics, or proven ability. This is for my area, proven ability to do quantitative work at the entry level, and then I expect that we'll teach people the rest, and they can learn again through on the job and through other kinds of training programs. At the master's level, oftentimes we want to see industry experience depending on the level I expect them to come in. At a lower level, they could just have a basic quant background and ability to learn. But if they were at a higher level, I'd want to see some industry experience. And then of course the piece that we talked about at the beginning, which is ability to I know you said don't say this, but ability to communicate clearly, to listen well, and the ability to do project management. I've worked closely with other parts of our organization, like our technology folks, people building big technology applications, and I've learned a lot about project management from them, and I've seen how our informal approaches to running projects don't work that well, and how that discipline can significantly improve our ability to communicate with stakeholders and get the job done well and on time. So that's a big value add if folks are learning that as well, an ability to apply that.
And when we adjourn for the drinks, there's a handful of other groups looking for undergrads and grad level people as well. I think Deutsche is here, DTCC, a couple of others. I think E&Y might have a table as well. So for those students that are interested in that, I would encourage you to spend some time at the drinks and networking reception, attending those tables and learning more about those institutions. Next question?
Yes. I have a question about...
Sorry, can you raise your hand? I'm not sure where you are.
Okay.
There we go.
Here okay.
Thank you.
So this question is for the panel as well as for other risk managers who are, people who are extremely experienced in risk field. From the body of knowledge wherever I am, we can see a risk manager really is an expert of all. He has to know any area that might affect the price, goes up or down. Do you see machine learning useful in your daily operations to help you to manage risk better? Because in the recent years, I worked with financial engineering interns, and I supervise them to work on projects in derivatives, in basically quant finance. And in recent years, like last year, the students came to me, they asked for machine learning projects. Sure. They want to learn more about it. And personally, I first took machine learning classes when I was an AI PhD student. So I know... I think
we understand the question.
Yeah, I know machine learning, but we're looking for projects.
Sure. Attilio, do you have any thoughts on that?
Machine learning has become a little bit of a fad recently. it's the one thing you want to say, especially on the portfolio management side when you have a quant strategy. Now, quant strategies that are based on signals and rule-based quantitative strategies, a lot of them now are sold as machine learning applications. So that's remember, there's like a three-way: evaluation, risk management, portfolio management. On the end spectrum of portfolio management, there's a big hype for machine learning kind of background in these recent years, not so recent. On on the risk management side, not really. I mean, the fact is that machine learning is related to another keyword that is in vogue right now, which is large data. And that portion, large data processing, more than machine learning, large data processing is a big word. But in reality, if I may, and I feel pretty strong about it, it's all about multivariate statistics. And so just learn multivariate statistics, learn it fundamentally at the very foundations, own it, and then it'll inform you your next steps into the fads.
So would it help in identifying, learning, and later being able to identify what kind of market conditions warrants?
No, it will not. Let me not monopolize the discussion, but no. You cannot hope to get from machine learning the crystal ball that will tell you what's going to happen next. So it's not happening. So let's not, cling on to that hope. Many people sell that proposition, but I see it as very unlikely. There will be someone who makes a prediction based on machine learning that will be right, just like there's always a broken clock is always right twice a day, right? So.
Monica?
Hi. So I have a question for you. Sorry, you keep on talking.
Oh.
Two questions, actually. One, I wanted to know operational risk within the buy side, how they're focusing it, because we saw Mark talking about it, but I wanted to hear your side. And the other one, for experienced hires who wants to get into market risk, what recommendations you have for them, and which areas should they focus their search on?
Yeah. So, and actually, the panel can be more solid than me in this. I'll give you my 2 cents. So, on the first question, that is an operational risk. It's actually a matter of definition being made right now these days, at least for us. So, and there are some measures that are purely qualitative that you cannot quantify, and I'll simply stay away from those. Basically, I don't have an answer for those. For those that are more quantitative, like the number of trades per day, the breaches and all those, you just put metrics and you just put automatic alert, and you have to sign off on a governance for escalation. So it's about deciding metrics with the usual bands, the green, the yellow, and the red, and having a governance that escalates the red band into the right people that are responsible for that. That's for the quantitative part. There's an ongoing effort to quantify as much as possible. Some of it is purely qualitative, and for that, I don't have an answer. That's on the first question. On the second question, on the experienced hire, what was the...
Experienced hires looking to get into market risk, what recommendations you have for them, and which areas should they go?
Yeah, so market risk and experienced hires. Well, again, it depends on what now I'll be a little bit cynical. If the aim is making a career, then probably the number one skill is people skill. But in reality, if you want to understand risk and if you want to have something to say in that direction, again, my recommendation is that you're very solid on the qualitative side. I have this bias, but to me, you can always add, and you have to add soft skills as you progress in your career, and that a lot of it is project management that was mentioned a lot. But you cannot make up for a deep quantitative understanding, especially on the market risk side, credit risk side. Liquidity is much more operationally related, so there's less of quant buzz going on. But for market risk and credit risk, you need to have a solid quantitative foundation, in my opinion. I don't know what you guys...
I'd tell you on the in the banks or securities dealers in the market risk function, and none of this is absolute. A lot of the clients I work with want to see someone who's actually managed a risk business, i.e. has sat on the trading floor. And I think if you looked at the background, a lot of the market risk, and I'm not saying I'm an absolute on any of these comments I'm making, but if you've had an opportunity even earlier in your career to sit in, again, this is my theme of sitting in a business, sitting in a risk business that, and then move into the risk function. And again, I've seen management take people out of the trading floor and put them in risk because they've been identified as good risk managers. I think that's a great building block on the sell side, banks for the market risk function that many banks I know look at, and therefore take some of their best internal people and move them into risk management.
I think one thing to add and kind of draw upon Attilio's comments about the relationship between kind of finance risk and the business. I've seen a lot of people very successfully move from whether it's middle office or product control or finance into risk. I think in the current, because again, risk is the change in value of your instruments or the risk of loss. So in the current market environment, for example, I would say people with really good product knowledge and valuation skills can really do well, for example, looking at stress testing programs in the risk function or CCAR, and looking at things like scenario creation or design because you're really understanding the idiosyncratic risks on your positions to valuations, how you would manifest that. I think things like the fundamental review of the trading book is another example where a lot of the sensitivity-based calcs are actually reliant more on valuation skills and maybe pure risk manager skills, and also tech and data skills. So I think finance, can either be an entree to then a second step into a risk field, or people in the room who are more interested in finance. I think that's a great segue into things like market risk.
Next question. Do we have one keyed up, or why don't we maybe try to congregate? If you have a question, maybe stand up and maybe make 2 lines, so it'll just be a bit easier.
Hi, my name is Mike. I work in UBS in stress testing. I had a question to Mike, actually. In your view, how can we get better at the identification of market risks? And the reason I ask is because, of course, I think currently the default way is to look at, to have a rearview mirror approach. So you basically look at risk non-invar, and you try to go from there and try to apply this into stress, so risk non-stress, etc. But do you see something which is forward-looking, let's say? So, unless you see the risk materialize, like you said, it could be market risk or credit risk, or operational risk, or legal risk, actually. How do we get better at seeing something coming along and then being prepared for it? So risk radar, if you can call it that way. Right. I think it's a good question, especially as many of the banks are constantly enhancing their scenario design and creation framework to be forward-looking. I think not a great quantitative answer to say how do you kind of look in the crystal ball and figure out emerging risks. But I think engagement with the line of business in the scenario design and creation standpoint, you really have to have risk managers who understand the idiosyncratic risks within the firm. I think you have to have also people who understand the industry to look at crowded trades and be able to say, okay, beyond my own bank, if anyone's running for the exit simultaneously. So you really do need that savvy risk manager in the second line of defense that's really engaged with the first line and understands the business and understands your bank's positions, but understands, again, what could be a crowded trade. I think that qualitative engagement is really critical to understanding it. I don't necessarily think there's going to be any analytic tools to kind of help mine for what that unforeseen risk would be beyond good business engagement with the front office in the scenario development process.
To add a little hat to that statement also, regardless how sophisticated a framework you set up, you will miss the future. So first of all, VAR is not just about the past. VAR is the quantile. It could be the quantile of a forward-looking distribution, so it could totally be forward-looking too. But other than the definition, you will miss the future. So I think that an important, healthy proposition is having contingency plans. So basically, even though you will miss the future, you don't want to be, navigating in the blind, and so you want to have the pipe set up properly to at least own. You might be heading toward the wall, but you know how fast you're going. So you need to have a speedometer. So set up your speedometer in your firm, and you want it to be properly lubricated and everything working just fine. Then second thing is the contingency plan. Okay, so if I hit the wall, am I gonna roll over the back door, or am I gonna have an airbag or so? Contingency plan. What's gonna happen when you trigger some events? What's your liquidity policy? What's your profit-taking policy, even on the upside? So I think that healthy risk management relies a lot on contingency plans rather than simply forecasting, which we all agree is a lost cause. We try our best, but it's a lost cause.
Actually, one other piece, instead of very forward-looking stress tests, I think the increased ability to monitor changes in market circumstances and react very quickly is really critical. So I think some of the firms that have succeeded the most in averting big losses are those that had really great daily mark-to-market processes firm-wide and could start understanding where the bubbles of risk were happening first. And I think that's, again, back to the finance-risk relationship. So I think a very strong daily marking process is really critical. It might not be that forward-looking stress test that you've had on your top 10, greatest hits list for your stress scenarios, but it might be that ability to convert quickly. I think also things like firms that have been increasing their abilities to get updated market data time series very, very quickly means you as a bank can understand how you're responding to changes in market environment. So again, it's back to almost having this concept of like an early warning indicator dashboard that tells you when you're starting to enter a confused state. That's as critical as having some predefined scenarios. And so you can't just look at your stress testing in isolation of having a really good early warnings system, which might not be your stress test, but a management response program.
Next question.
Hi. First of all, thank you all for giving this panel. I think it's fantastic. Here's my question. What kind of qualities do you see from an undergraduate students who don't have much professional experience as potential to succeed in risk management?
Yeah.
I know John might want to continue your topic.
Yeah, I mean, I would just, if I just chime in, so I think we touched earlier about being inquisitive. I think wanting to learn, ask the question. I think being a team player is really important also, because often you're relying on other team members to learn together, to explore the organization and learn new concepts. So I think we're really looking at, communication, being inquisitive, looking to always learn and understand new things, as well as being able to operate effectively within a team. I think that's really key from my perspective.
Well, one thing that maybe is a little orthogonal, but still is the fact that you want to find people that are truly interested in risk management. I found quite often that some people are portfolio managers want to be in disguise, and they think that risk management is a top necessary evil to go through before you can find something better, that better being managing money. So I personally really value the passion. There is such a thing as a passion, not saying it just for fun. Those who know me know that I mean it. There's a passion for understanding risk, and you want to have that. So I personally try to spot that in the people that I interview, and I fail in doing so.
Take a couple more.
Siddharth Asthana from Deloitte Consulting. Thanks for having us here, and it's been absolutely wonderful learning from your experiences. My question is more towards Mike and John. I would want to know that within, outside of FSI world, have you seen in recent years a growing interest in risk, especially in the high-tech clients that have a lot of cash on their balance sheet and they are trying to manage a lot more credit risk as opposed to and liquidity risk as opposed to traditional banks?
Sure, I can take that first. I would say, so I guess the question is outside of the banking sector, have we seen increases in just risk management and management programs? Yeah, I would say to your point, I'd say very large corporate treasuries have really taken an increased look, probably more on how they're managing their cash in an effective way and what a rate rise might look like for them. And then we've definitely seen, at least in my firm, we've seen energy companies taking a much more detailed look, again, at hedging programs and actually liquidity risk and funding liquidity as well as market liquidity. I would say are some of the sectors outside of the banking sector that we've seen look at things. I think the shadow banking sector is, they might be on the cusp of some regulation around either capital and or liquidity and things like money market mutual funds. But I wouldn't even say as a preemptory measure, they've started to take a better look. So I would say that, that sector has taken a harder look at things like diversification criteria or what kind of buffers they would have to have. And we've seen some work there. I would definitely say the CCPs, a little bit more of a regulatory response, but with all the FMU requirements for risk measurement and management infrastructure and maybe even having capital buffers has definitely been an area that I wouldn't call bank, but again, the CCPs and the FMUs have really undertaken significant risk transformation programs as well.
I think the question, we have not, in my practice, have not seen the non-FI companies, you may say cash-rich treasury functions, at least from a recruiting standpoint, asking us to reach into the FI risk world for that function. I think that was a question. What we have seen is that non-financial services main boards trying to recruit risk people to their board, and they think some of the best risk managers are coming from financial services. So you could have literally a large energy company, which obviously could have some risk, has plenty of risk in a number of areas, but energy technology company coming to us asking us to recruit financial service risk people to their board.
Let's take one last question.
Okay, this question may have already been asked, but I'll take the risk. My question is, which group within your firms or groups actually deals with the differences that most likely exist between the risk measures and metrics and policies that you're following that actually do something to protect your firm so you can go there again tomorrow morning, versus those that just keep the regulators happy?
Anybody wants to take it? Okay, so we're in the process of building up a consolidated risk infrastructure that addresses both sides. So in our shop, we're doing it. There's only one set of numbers, asymptotically speaking, going out to both fronts.
Yeah, from my perspective, with Morgan Stanley, big focus on both. Obviously, the regulatory regime, as I mentioned earlier, right now is driving a significant requirement. But I think it's recognized within the firm that the key is really how you leverage that and what the other data we have to really become a management tool. So we focus very much on risk tolerance and appetite frameworks, how we work with senior management, the board, the broader organization to understand the significant risks the bank faces, and then how do you kind of quantify that and then monitor that. So it's a combination of the regulatory-driven piece as well as what you do over and above that to make it useful for management.
I'll just make one comment. I think one other lens to potentially think about this question through is if it's an orthogonal dimension, there are things that regulators care about, there are things that firms care about. I think it's somewhat a misspecified question. I think part of it is there's a spectrum of things that, as an industry, we should care about. Some of those things that regulators are asking us to do, quite frankly, we've wanted to do for many years, and it's actually quite nice to have regulators telling us we have to do it because we can get budgets to do so. There's a lot of other things that we'd be doing anyway. I think the number of things that we're being asked to do that are just really purely for regulatory, I think is probably less than 20% of everything that we do. And as long as we keep it to that kind of healthy level, I think the industry as a whole will be far better than we were pre-crisis. If that starts creeping up into we're doing half of our work purely for the sake of satisfying a regulator, I think we're going to be in a very difficult space.
Yeah. And Lon actually raises quite an important point, which is quite often the regulation is extremely useful because there are things that we want to be doing, and it's useful to be able to leverage the regulatory requirement in order to implement a process. So if I just take one example, new product approval, when the firm launches new products, operational risk, reviews those products to make sure that we can settle it, we can support it, and that it's not going to introduce too much risk to the firm. That's something the regulators are driving more and more, that operational risk should be in that space. So that is useful for us to leverage that when we're speaking with the business and others to crystallize our role and the requirement that we have, in addition to the management benefit that comes from it.
I just want to thank everyone for attending this evening. I want to especially thank our panel.
Can I do the quick plug? Hang on. Just 1 second. The plug. So for those of you who are quants, there's a boot camp, the Advanced Risk and Portfolio Management Boot Camp this summer in your city, 1 week in August, Monday through Saturday, Monday morning through Saturday night, straight, pure quant pain. Some of you in the audience have been to that one. It's an intensive course with theory, practice, exercises, and a bunch of guest speakers. GARP is a big supporter. Chris, is Chris in the audience? Where is Chris? Chris, the FRM person, the lead of the FRM, is giving you guys 40 CP units for that one, correct? So, well, anyway, if you come 1 week in the summer, reach out to me, reach out to Chris, and let us know. We'll be happy to have you. Thanks.
What a rowdy panelist. Thank you for the panel. We have some drinks and refreshments, etc., outside, so I look forward to seeing you there.